Hi, my name is George Dagnino. I'm the editor of the Peter Dag portfolio. What I would like to do with this video is to show you how cyclical are stock prices and earnings and how the two are very closely tied together by the business cycle. I will also show at the end the method we use, the process we use to select stocks. It's sort of short-term kind of investing, but it's producing great results. So several of you asked me to review them again, the concept, so I will talk about it. So here we go. When analysts and commentators talk about the business cycle, they talk right away about the Fed, the government, deficits, debt, and they go on expressing opinions. What I think my approach is business that takes all this information, process it, makes decision based on what they see in the business environment, what they see, what the consumer is doing, if they're ready to buy or not. And based on that, they make decisions. And this decision impact commodities, interest rates, and everything else. So where we are now. Right now, well, no, let me start all over again. The business cycle is in four phases. And the most dangerous one from an investment viewpoint is the end of phase 3 and phase 4. Phase 4 is when interest rates, commodities, inflation, everything comes down, stocks, everything. At the end of phase 4, what you have is business has inventories very low, in line with declining sales, which, by the way, this is exactly what is happening now. So what is when consumers see inflation and interest rates declining, they start buying more. And this is where you have the buying, production increases, you hire more people, you buy more raw materials, you borrow more to get production going. At some point, and this is where, by the way, earnings start growing fast, because now you have stronger demand at the beginning, your costs are down, so you make more money. Earnings growth very rapidly. However, what happens here at the end of phase 2? Inflation, interest rates are rising, and the consumers beginning to have problems with income, and therefore they slow down their spending. So they slow down their spending here in phase 3. Business keeps on producing, doesn't recognize at first that sales are slowing down, so they keep inventory high. At that point, earnings start slowing down because it costs of carrying inventories. And this is what is the peak in earnings. So business cuts production, cuts inventories, reduces the purchases of raw materials, borrows less because now there is less to finance, and therefore you see the process that is correcting. It's correcting, and it ends up in phase 4. This is when everything gets cleaned up. Earnings keep on going down because now demand is low, costs are still high, interest rates are still high, but eventually there is a washout of everything, and this is when consumer will find eventually there's some type of purchasing power, inventories are in line, and the cycle starts all over again. What I would like to do next is to show you how earnings, and I'm showing you data, how earnings behave during this phase, and how the market is responding, and what our indicators is saying, and what is the outlook, which is probably what you really care, and what we really care to see how we're going to invest our money. All our videos are on the patreon.com/Peter Dag, and we have 3 membership. The first membership, number 1, is you will get all the videos like this one. The level 2 membership is you have videos, and we send economic and financial updates every time there is an economic indicator that seems to be particularly important for our study of the business cycle. We send this financial analysis. And the number 3 membership is you get the Peter Dag portfolio, which is a 22 pages report twice a month all the videos, of course, and all the financial and economic updates that we find appropriate for you to review. Well, I thank you very, very much for following this video. I hope you stay or will become a member of our Business Cycle Academy, and I wish you a wonderful day. Thank you very much, and I hope to see you really, really soon. So long.